A strong narrative drives the market for around 3 months, and right now, a new media trend is emerging. Let's find out which one it is and how much of it is priced in. Hi, I'm Josh, presenting for Visual Sectors. Last week, my colleague Mark promised to explain how to evaluate news. So here are the 3 things that I will cover in the next 10 minutes. First, how to spot a media trend that will last up to 3 months and drive the stock prices significantly. Secondly, how to evaluate the timing of the news reaction. Do they have a long or short-term effect? Finally, a simple way to quickly understand if the news is already priced in or not. So, how did we come up with the 3 months media trends? Pure observation. Here is the S&P 500 chart. Let's just add the dominating headlines on it. Here is the Fed tightening peak, driving the market up from October 22nd lows. Then comes the bank crisis. Later, the debt ceiling. See the pattern? A big narrative like this takes time to unravel. But there is more to it. There is actually actionable data not only to react to the news, but to predict some of the major events. Next week we will talk about the earnings season expectations. In July, we got 85% win rate on our earnings predictions, so please sign up and be there for next week's video. So which media trend wins the headlines next? Now we have quite a few stories in the early days. Let's have a quick look. The bonds crash topic is driven by supply-demand disproportions in the US government treasuries. A $1.8 trillion budget deficit is not going anywhere, and even the very attractive yields can't beat the increasing supply of new debt. Quite a few big names start talking about this. Ray Dalio was the first to mention the problem back in April. Now Barclays analysts are covering it too, and Bloomberg put it on the front page. Media momentum is building up while the 10-year bonds yield reached 4.9% on Wednesday. The other big emerging topic is recession. It kicked off on the last FOMC meeting when Powell said that soft landing was no longer the base case scenario. It triggered quite a discussion. Federal Reserve Bank of New York conducted a poll among CEOs of American corporations. 84% said that they expected recession in 2024, yet 0 FOMC members do. This narrative is building up. Morgan said the profits will be hit by USD strength. Jeff Gundlach talked about narrowing yield spreads. By the way, we talked about all of it in our August video with market scenarios. Click the link in your top right corner if you missed it. So, which narrative is more likely to dominate? We believe that the recession narrative will have way more occasions to be discussed. Employment data, CPI data, growth data, PMI data, polls. So many things that famous economists and traders can discuss. A constant source of topics. But what if it's already priced in? That is actually quite easy to check. I know that when you look at the market price action, it's hard to tell if the drop is finishing or only starting. That's why we follow the options traders. They actually have to access not only the direction of the bet, but also the timing and very specific targets. Look at a typical options contract. You have to pick an expiration date and a strike when you place a trade. No matter how complicated your strategy is, you still have to do it. That means we can see the accumulations of open interest and understand the expectations. Let's break down one of the events to see how it works. The market went up on Wednesday, October 4th after a weak jobs report from ADP. The inverse logic of investors stepped in. The worse the economy feels, the sooner the Fed will bail it out. This sentiment drove Nasdaq up by 1.4%. But let's take a look under the hood. October bets witnessed a solid increase in the SPY $456 upside target level, 4,466 new contracts, an equivalent of $1.9 billion in notional volume, 30% of the total position open interest. November contracts traded in the positive territory as well, but at a lower volume. Only 5.43% increase in the $450 target. December expectations, however, switched to mixed. Identical open interest increase in bullish $450 bets and bearish $380 bets. Longer-term investors did not buy it at all. Zero bullish bets increase, while $405 and $400 downside accumulations went up by a combined amount of almost 10,000 contracts. So what does that tell us? The effect is short-term and really limited. Speculators tend to jump on the Fed pivot narrative. Longer-term investors are worried about recession more, and their buying power is at least double of what speculative traders are ready to invest. So let's just say this headline's reaction is fully consumed, while the recession narrative has a lot of time to unravel. But how low can it go? January Bet suggests the bottom of $405 and $400 for SPY, an ETF that represents the broad market stocks included in the Standard & Poor's 500 index. For the last 3 or 4 months, the most consistent support was traded at the level of $420. So, if we look at the short-term data, the fears are priced in. But the dynamics of macro trends suggests that we can see another 5% decline in the next 3 months. But that's pretty much it. The majority of current accumulations for December of 2024 still show that $400 is probably the low. This can change easily, and it probably will if the Federal Reserve starts supporting the economy and soften their policy. To summarize, I have to remind you that the market is always trading expectations. Waiting for a recession is not yet the consensus, and the narrative still has about 10 weeks to gain full power and reach the lows expected by the options traders. But some other media trend will step in and switch the sentiment, and we will definitely go through it again when that time comes. But for now, stay on the safe side with visual sectors, and see you next week.
Visual sectors is the perfect answer to the win question. We help retail investors understand key trends in the market, and our data sets put a calendar date on them. We source the most complicated data from Standard & Poor's, FactSet, and Options Pricing Reporting Authority to turn them into easy-to-read charts with up to 72% win rate based on 10-year backtest.